Okay, so imagine this. You find one idea in Barron's, just one, and it leads to an $80 million risk-free profit.
Wow.
Which then apparently turned into something like $500 million working with Lilu. It just shows what you can find sometimes.
Absolutely. And that kind of thinking, looking for those specific situations, that's really what our source today is all about.
Right. So today we're doing a deep dive into the event-driven edge in investing. The author is Asif Suria.
Exactly. And the whole idea is looking at specific company events, mergers, spin-offs, insiders, buying or selling as triggers for investment opportunities. It's a different angle than just like general stock picking.
And Surya seems to know his stuff. He's an investor, entrepreneur, got decades of experience focusing specifically on these strategies.
Yeah, he's been writing for Seeking Alpha since, 2005? And he actually builds his own tech tools for this stuff. The book came out in 2024, and he basically argues that these event-driven plays can help you potentially beat the market.
He even talks about his own journey, right? Making mistakes early on, like with Enron.
Oh yeah, we've all been there in some way. But then he discovered this whole event-driven world around 2010, starting, interestingly, with merger arbitrage.
Okay, so let's start there then. Merger arbitrage. What's the basic idea?
Well, at its core, it's about buying stock in a company after it's announced it's being acquired.
Right.
You're buying it usually at a slight discount to the deal price, and you make money from that small gap, the spread, when the deal actually closes.
There's risk involved.
Definitely. The deal might fall through for some reason. That's why it's sometimes called risk arbitrage. It's not a sure thing.
Can you give us some examples? Maybe one straightforward, one more complex?
Sure. Think about Berkshire Hathaway buying Allegheny. After the announcement, the price difference, the spread, was tiny, less than 1%.
So small potential profit, but pretty likely.
Very likely, given it was Buffett.
Yeah.
And it fits his style, right?
Yeah.
He famously prefers buying whole companies, even advertised for it back in '86.
Huh. Right. Okay, what about a riskier one?
Well, the whole Elon Musk and Twitter saga is a perfect example. That spread got really wide because there was so much doubt the deal would actually happen.
So much higher potential return, but also much higher risk he'd walk away.
Exactly. And that whole situation really put a spotlight on things like the specific performance clauses you find in merger agreements.
Interesting. So what's the main takeaway for merger arbitrage then? Should people be doing this?
Well, the key thing Surya points out, based on data from 2010 to 2022, is that most deals, like 95%, actually do close.
95%? That's higher than I might have guessed.
Yeah, so it suggests it can be a pretty consistent strategy. But, and this is a big but, you have to understand the risks. Regulatory hurdles are a big one. Think about the FTC looking closely at the Microsoft Activision Blizzard deal.
Right. And the type of deal matters too. Cash versus stock.
Absolutely. All cash, all stock, cash plus stock. They all have different implications for the arbitrager, different risks. Okay, let's shift gears. How about insider transactions?
Yes. Watching what the execs and board members are doing with their own company's stock.
Precisely. And the general wisdom is that insider buying is usually a stronger, more positive signal than insider selling. Selling can happen for lots of reasons, but buying, that usually means one thing.
They think the stock's going up. Any good stories there?
There's a great one about Jay Hoag, who was on the Netflix board. Back in May 2012, Netflix stock had cratered, really fallen hard.
I remember that period.
And Hoag stepped in, bought $25 million worth of stock. A huge vote of confidence.
Wow. And did it pay off?
Massively.
Yeah.
The stock, as we know, recovered and then some. And Hoga wasn't just any director. He had an investment background, was independent. So his buy signal carried, extra weight.
Makes sense. What about looking at the bigger picture, not just one person?
That's also really telling. So during the COVID crash, March 2020, if you looked at aggregate insider buying across the whole market, for a brief period, buying actually exceeded selling, which almost never happens. Yeah, it suggested that insiders, as a group, saw a massive opportunity when everyone else was panicking. Sites like InsideArbitrage.com track this sell-buy ratio.
So how do we use, there must be tons of insider trades happening all the time.
There are thousands, yeah. So you look for patterns. Cluster buying is one signal. That's when multiple insiders are buying around the same time.
Okay. Safety in numbers.
Kind of.
Yeah.
And context matters. Are they buying after a big stock drop? During a market panic? Also, you need to understand the Form 4 filings. Look out for late filings, different transaction codes.
Yeah.
It tells a story.
Got it. Okay, one more strategy. Spin-offs.
Right. This is when a big company carves out a division and sets it up as its own new independent company.
And why is that an event for investors?
Because often These new spin-off stocks tend to underperform right after they start trading.
Why is that? Seems counterintuitive if it's a good business.
It's often due to forced selling. Big institutions holding the parent company's stock might get shares of the spin-off, but maybe the new company's too small or doesn't fit their mandate. So they just sell it, regardless of price.
Creating downward pressure and potentially an opportunity.
Exactly. For investors who do want to own it, Ferrari's spin-off from Fiat Chrysler is a classic example.
How did that turn out?
A bit shaky at first, but then it massively outperformed the S&P 500 over its first 5 years. Huge success.
Any more recent ones that illustrate the idea?
Well, consider the Biohaven situation. Pfizer bought Biohaven Pharmaceutical, but part of the deal involved spinning off a new Biohaven company.
Okay.
The main acquisition had a premium, sure, but the spinoff included cash, potential royalties, and an insider bought shares just before the deal closed. That might hint at some perceived value there.
Interesting. So what's the big picture takeaway on spinoffs?
They can unlock value. You get a focused management team free from the parent company bureaucracy. Suria uses this great analogy. Like Carroll Shelby getting control of Ford's racing program and finally winning Le Mans. That independence can drive performance. And that initial dip in the stock price, that could be your entry point if you're patient.
So wrapping this all up, it seems like event-driven investing gives you a really different lens to look through, doesn't it?
It really does. You're focusing on these specific catalysts, the merger, the insider buy, the spinoff, rather than just general market or economic trends.
And as we've seen with these examples, understanding why these events are happening, the mechanics behind them, that can potentially lead to some unique insights and returns.
Which brings us to maybe a final thought for you, the listener. How could you start weaving analysis of these kinds of corporate events into how you look at investments?
Yeah, what sources beyond just the stock price charts could give you that event-driven edge?
Maybe it's digging into SEC filings sometimes or tracking those merger spreads we talked about. It could be where you uncover your next, really interesting idea, something to chew on.